right, this is the Banking and Institutional Adoption panel. On it, we have reps who have expertise covering capital markets, insurance, custody, regulatory issues, and legal. On this panel, we hope we can talk about the broad arc of where institutions are in relationship with crypto and blockchain as an emerging technology, and also give some practical advice to business leaders. I'll let the panelists discuss more about their backgrounds as they answer the first questions. First, I'm Mike Castiglione, formerly at CIA, now at Eventus. We're a financial compliance company. I'm here because at CIA, I analyzed the geopolitical significance of emerging technology like crypto. And at Eventus, we build software to detect market manipulations for financial institutions. Right, so we'll get into the questions. The first one's for you, John. So when you think broadly about the history of useful technologies, there's usually a pattern, and the pattern is something like there's a core group of believers who adopt it first, and then there's a shift in phase to the early majority adopters, and that spurs established businesses to invest more into the technology. So with crypto, where are we in this broad arc? In your mind, what are the most significant examples of institutions investing and experimenting into crypto?
Thanks, Mike. Great question, and thanks, everybody. I know we're probably standing between you and lunch right now. What I wanted to really just quickly rattle off here are some important names of institutional adopters that these are at least household names for people like us here in this room. And those are names like JP Morgan and Goldman Sachs and HSBC and Bank of New York Mellon and Starbucks and Amazon, right? Both financial and non-financial use cases, but significant investments in adoption, right, across all those firms. And that's just a sample of some of the bigger, better-known names that have invested for years to get to this point, right? And I think we should all really sort of look at names like that as confidence in this ecosystem, in this technology, as something that is here for the future and something that does take a while to really, foster adoption and foster use cases and proof points, right? But those are some really big, really important names to pay attention to, Mike. So great question, but I think really some great examples of what's already happening in the market from an adoption standpoint.
Before we move on to the next question, does anyone else want to kind of add kind of insight of the state of play of where institutions are? So again, the notable examples of what's being built right now.
Sure, I'll just mention, I'm Jim Vivenzio. I just retired from the OCC 2 months ago after 32 years. I was their BSA AML policy director, and currently with Perkins Coie advising financial institutions on BSA AML issues. But one of the things that I'll point out is there's just an FDIC IG report that came out about 5 or 6 weeks ago. And the IG report points out that there are about 130 community banks that are either in or continue to be interested in getting into this space. And so I thought that was significant. And then the other thing I'll just point out is there's been a lot of negative issuances from the federal banking agencies and other agencies as well, sounding alarms with regard to crypto activities. But all of those agencies, still have their offices of innovation. And, in fact, at the OCC, I know the office was recently elevated to a higher level within the agency. So certainly, those avenues are still open, and the consumer demand is significant. In fact, that's always been one of the things that always just surprised me about this space was just how quickly the volumes ramped up, and that was just illustrative of the need and the demand out there.
Okay. So as you engage with regulators, don't forget about the offices of innovation. Jim, I want to keep with you on this question. So a major theme so far in the summit is that regulation has been a blocker to more investments and experiments for institutions. Well, at least in the United States. And meanwhile, several banks are under stress, maybe the entire system right now. So you are a former regulator. So just this year, there have been some major regulatory shifts regarding financial institutions and banks. Could you explain, to your mind, the most significant regulatory changes that business leaders need to be aware of?
Sure. Most significantly, on January 3rd of this year, the federal banking agencies put out what I refer to as the crypto risk statements. And it lays out a laundry list of risks related to cryptocurrency activities, including fraud, lack of sound legal principles in some cases, and other things as well. But most importantly, the statement also points out that it could be an unsafe or unsound banking practice for a bank to hold crypto assets on balance sheet. And that's a significant statement that the federal banking agencies made there. And then the other significant statement that they made is that it could also be an unsafe and unsound banking practice for banks to have concentrations within the crypto asset space as well. So two major safety and soundness concerns being raised by the regulators. And a safety and soundness concern is significant because it empowers the regulator to take penalty actions against banks that don't come into compliance. So if you're a bank and you find yourself in that situation, you're going to need to come up with an action plan to address those concerns. The other thing that came out also was what I refer to as the crypto liquidity risk statement, that pointed out some of the risks relating to crypto asset-related company deposits. And it points out just how interrelated many of these entities can be, and just how quickly these deposits can disappear from an institution and be pulled, causing liquidity crises within those banks. And interestingly, this statement also had a significant monitoring obligation that it placed on banks that required banks to actually monitor their crypto asset customers for how those customers are communicating FDIC insurance representations to their customers. So again, it's a monitoring obligation being placed on a bank with regard to their customers. Again, these are additional costs. And then I just also want to point out there was another issuance about 2 weeks ago that was signed on by the Department of Justice, Department of Treasury, Department of Commerce, and this was OFAC Sanctions in the trade context that has this concept of transaction due diligence in it. So in addition to customer due diligence, there's this concept of knowing your transaction that would also include intermediaries and counterparties. Now, this is in the trade context, but the statement is very broadly drafted, and it says specifically that the Department of Justice can apply those principles to other enforcement regimes, which would possibly include, beyond OFAC and sanctions, but BSA and AML as well. So this concept of transaction due diligence, it kind of reminds me of what happened back in December of 2020, when FinCEN came up with the unhosted wallets rule that kind of had some counterparties issues in there. And it looks like we might be going down that road again, so stay tuned. Oh, and then just one more point I want to make. Lots of guidance that was promised to us from the banking agencies. The third-party risk management guidance, the crypto sprints guidance. That's all being held up, and I would surmise it's based on what's going on, and the lessons learned will likely be built into those guidance documents. And I'd also be remiss in not pointing out, the SEC proposed rules that were recently issued, with regard to qualified custodians as well as third-party outsourcing. So very comprehensive requirements there also being imposed by the SEC on investment advisors. So stay tuned. You also have the AML Act regulations that are going to be coming out. Lots of change in this space. And so.
That's a good point about unexpected events holding up regulators' forward guidance. I also want to talk about custody and bring in Glenn Barber into the conversation. So when things go wrong in the financial system, people realize how important custody is. And it's essentially how we assign control and ownership and security to anything of value. And established firms, banks, have precise rules about custody. So, Glenn, for digital assets, what techniques or technologies are available to upgrade the concept of custody?
Thanks, Mike. Look, I think this is a really relevant question. Excuse me, I'm sorry, I'm losing my voice, so I'll do the best I can. I think a lot of financial terms and guidelines have been around for a long time, decades, if not centuries, right? And custody really is one of the core founding principles. You want to have the highest level of safekeeping for assets possible. And I think that custody really has been grounded in physical security, whether it's money in a bank, gold in a vault, or anything similar. And I think that one of the things that presents challenges is that we have a unique asset class in digital assets. It's inherently virtual in nature, inherently borderless and global, and can be absconded with in the blink of an eye with nothing more than a broadband connection, right? So you have this construct that has been very powerful and has been validated over time, where the custodian has to have full control subject to the instructions of their client, right? I'm not sure that's the right definition of custody at this point, because in my mind and in other people's minds, that's a single point of failure, right? Because in digital assets, you have a private key that governs ownership of the associated digital asset. And there are new technologies like MPC, and we don't have to go into it, but it's called multi-party computation, that says instead of having one single point of failure of that private key housed in a very secure location, through technological advances, you can have key shards that are held at different entities. And if one entity is hacked, or there's employee malfeasance, or someone loses a shard, it's not the same catastrophic event that you would have if you had the whole private key controlling the asset in one location. So I think, my hope is that the regulators and participants will be much more thoughtful about how the definition of custody is applied. Because again, I go back to this premise that digital assets are so unique and so markedly different in so many different ways, from equities, bonds, commodities, and currencies, that we should be a little bit more thoughtful in how to apply something like custody. Because really, at the end of the day, it's the fiduciary responsibility of anybody to make sure that the assets they manage, either for themselves or on behalf of other investors, is held as safely as possible.
Okay, so that's custody. And another element that really matters when things go wrong is insurance. So this one's for you, Glenn Morgan. Insurance, to my mind, is often an unsung hero of a sound economy, because it caps the downside, it prevents ruin, and it allows entrepreneurs to take calculated risks. So if an established business right now wishes to build into crypto, how does insurance help it take calculated risks?
Thanks, Mike. Been in insurance for a while, and I don't know if I've been referred to as the unsung hero, but I appreciate that.
You're a hero.
I'll take it here. But I think that to insurance piece to this puzzle is, if banks or if traditional financial other institutions want to get into crypto, they need to be able to show that, if they're transacting or they're holding assets, that it's safe and sound. Like Glenn's saying, you want to have custody. So insurers are going to want to see, what kind of processes, what kind of tools are you doing to, mitigate your risk internally. And, if it's a bank who's saying, we're going to offer this new crypto product or service, we're going to offer, staking services or something like that, what the insurance companies want to know is, okay, what type of credentials do you have to be doing this? And, who are you working with that enables you to be able to have this access? What type of technology are they using? Are they using HSM? Are they using MPC? And so, that also folds back to the crypto natives and where they, filter in. They're the ones that really have a hard time getting insurance. It's not the banks, because banks have been around for hundreds of years. They have very long-standing history relationships with these insurance companies. So when it comes down to writing a policy to address liabilities or to address loss of assets, there's certain tweaks that need to be made to products that already exist. But those products are going to still exist and be scalable for the people with the deep pockets. The people who have trouble obtaining these policies are the crypto natives, the startups, the growth companies, but they're the ones with the technology and the expertise to be able to adequately provide these services. So what regulators want to see and what banks want to see, they come to these crypto natives, say, we want to work with you, but we need you to have insurance. And so that's, kind of where you get this cyclical process, and then, you have regulators looking back and saying, why don't you have insurance? It's because, well, we're unregulated, and, insurers don't want to be on the hook for this. So it's definitely come a long way for where we started, but still have a long way to go.
Okay, another question for first you, Jim, and then you, John. So banks and financial institutions, kind of one of their hallmarks is that they already have strict compliance processes and requirements, and a shockingly large amount of their personnel is devoted to compliance. This could be a strength, this could be a weakness, depending on how you look at it and what you're trying to do. So Jim, in this environment, what are the real challenges that crypto businesses have in developing a business relationship with a bank in the United States?
Well, the challenges, from the business perspective is, coming into a regulated environment that they may not be familiar with. I mean, the banking industry is so heavily regulated, and this is something I would see often is just a clash between the cultures. So if to form a relationship with a bank, you're going to have this expectation of regulation, and develop what's known, we call within the industry, a culture of compliance within your organization, and that's going to be an expectation that the banks are going to have. The banks are also have expectations when forming business relationships. And there's actually a very useful piece of guidance that the federal banking agencies put out back in August 2021. It's the Community Bank Guide for Forming FinTech Relationships. And even though it's directed towards community banks, it's good for all size banking institutions, because it just gets into several of the best practices that the banks should be taking, with regard to customer due diligence of the company, the due diligence of the company, their financial information, their governance processes, their IT security, and the document gets into each of those areas and provides, detailed, sub areas within each one that the banks should be thinking about, as well as where to get that kind of information. Useful document, and it would also be useful for the companies to become familiar with what the bank's going to be asking about. And then the other thing you also need to be aware of is that there's a federal law called the Bank Service Company Act that basically subjects companies that fall within the definition of a bank service company to federal regulation and supervision, including enforcement. That's another significant act that companies need to be aware of when forming these relationships. Is that depending if you fall within that definition, you could be subject to regulation by the federal banking agencies. And then the third thing that's important is just making sure, as a banker, that the banker has a firm understanding of what the relationship is, the risks involving the relationship, the complexities of it. Especially from a consumer compliance perspective, banks need to know what's happening on the consumer side. That's very important. And if there's a relationship that is mistreating consumers, and the bank isn't aware of that, that's a problem. There needs to be transparency there with regard to how consumers are being treated. And so it's not going to be unusual for banks to expect that you have some consumer controls there that would need to be reported to the bank if the product that the bank is representing itself behind has some consumer problems. The big things are consumer compliance, culture of compliance, and then you've also got obviously BSA AML issues and who's doing what. You never want to be in a situation where something goes wrong from that perspective, And the two companies are pointing their fingers at each other, saying that I thought he was doing that, or the other company was doing it. And there's a gap in monitoring. Gaps in monitoring have been prosecuted by the Department of Justice on the criminal side. So, the BSA, AML, and OFAC obligations really need to be spelled out carefully.
Yeah, one thing we talk about at Eventus is it's important to know what is being enforced now and also anticipate what might be enforced 3-5 years from now, because those investigations are naturally backwards looking.
Right, and lots of changes coming up in that space as well, with the Corporate Transparency Act and all the beneficial ownership obligations, and the customer identification program rules, and who's got a customer relationship and who doesn't. So stay tuned there. There's going to be a lot of developments in that space.
So John, given those requirements, the complexity of getting it right, and the likelihood of even more complex requirements as regulators deal with current instability, what practical things should businesses consider, should they do to kind of navigate relationships with banks?
And Mike, it's a great question, because I think it's what should blockchain, crypto, Web3, digital asset companies do, and what should the incumbent traditional institutions do to support the adoption of this new entirely new paradigm? Right, and I'll start with a story. I'm part of FIS, part of the Web3 team at FIS, building next generation rails for banking, for payments, for investing. And FIS is one of the largest incumbent FinTech providers in the industry. I had the pleasure and the luxury of being in front of some of our largest banking clients, I think representing about $2 trillion of deposits. I was in front of the team, or in front of this team of clients, they were all CIOs. We were in a room, small room, and I was presenting the benefit of presenting Web3 to them. What is Web3? What's blockchain technology? What are the different opportunities with this technology to apply it across the entire financial services ecosystem? And the first response from that CIO audience, representing $2 trillion of banking deposits in the US across some of our biggest clients, was, we have 3 compliance staff for every technology person that we have on our team. Just so pre-Web3, the compliance burden that the banking industry, the financial services industry is dealing with is massive. And so the ask of this CIO team of FIS, and really of the FinTech industry, is really find ways to solve and provide complete solutions that are not just technology solutions, but solutions that encompass regulatory awareness, regulatory support, understanding where the puck is going, not just where it is now, understanding the legal frameworks, understanding the technology, obviously. But I think the advice I would have, based on this feedback and even the work that we're doing with our clients today, the work we're preparing for tomorrow, it's really all about trying to weave together the entire narrative of regulatory, legal, compliance, operational, and technology considerations all into one. And that's honestly a lot of the work that we're doing today, is to try to piece this all together, because that is the solution, and those are the solutions, those complete end-to-end solutions are what the market really needs to drive adoption in traditional institutions for both financial, even non-financial use cases. Right? And that would be, I guess, the call to action for everyone here. It's not just about the technology. The innovation that all of us here in the room are, it's ironic that the event here, we're sitting in the heart of, the heart of Washington, D.C., talking about blockchain technology, but the innovation and the role that we all have to play in sort of driving adoption here, based on this client feedback, is being aware of the policy, and influencing where the policy is going. This is why the chamber plays such an important role here. The adoption of this technology at scale requires absolute, to be in lockstep with the regulation, with the law, and where that's going, right? And that's really, I think the most important advice for both incumbent FinTech providers, incumbent financial institutions, as well as the providers, maybe many of the providers here that are represented as well, who have a policy presence here in DC and globally, all very important because those are the solutions that the financial services industry needs to really drive adoption at scale.
Yeah, I mean, naturally, DC is very important, and so are other capitals across the globe. And that's why I wanted to pivot to Glenn Barber, Glenn Morgan. Your two companies have roots outside the United States, and it's always important to learn and get inspired and kind of get the best practice of what other jurisdictions are doing. So as you look around the globe, are there examples of other countries, other governments, kind of setting the right guardrails for crypto that, in your mind, are giving the right incentives to build, to invest, but also do so in a mindful way where you're kind of thinking about the risks?
Sure. I think there's at least 4 that come to mind pretty easily. Copper is headquartered in the United Kingdom, and I think there's a lot of work being done by the FCA and other British regulators to really articulate a defined crypto framework for digital assets. Look, like any country, there have been fits and starts, but I think that they are really coming to grips with it's more about the blockchain technology than the digital assets that necessarily sit on top of this blockchain technology, and they're being pretty thoughtful about it. We have a lot of businesses primarily in Switzerland, and I think that Switzerland has done a really admirable job in sort of creating a middle road where they have what they call a FinTech license, and it allows for people to not only custody digital assets, but be known as a provider of technology services, right? And so it's not a, either or, you're, subject to complete and utter banking regulations, whether or not appropriate for the asset class or not, or you're basically out in this gray area of unregulated, nothingness, and it's buyer beware, take your risk, and, regulation potentially by enforcement. So I think that the Swiss have been very thoughtful. The European Union gets accused of dragging its feet, but they usually drag their feet because they're very thoughtful about things. They discuss things a lot. They look at it from other angles. And then the last 2 things I would mention is, there a lot of progress being made in Abu Dhabi and Dubai, especially when it comes to the tokenization of assets, whether you consider it to be intangible or illiquid assets, funds, and other things where just distributing tokens and value representations of assets is going to be driving the market forward, and I think they're taking a very leadership-oriented view on that part. And lastly, I'd call to mention, it's a little bit surprising, but the fact that Hong Kong might be legalizing, ETFs, whereas China has obviously pushed crypto out of their country as rigorously as possible, certainly when it comes to the retail investor. And now you have, obviously, Hong Kong, which has been brought much closer to the mainland than most people thought would happen. And all of a sudden, you're getting thoughts about, we're going to have ETFs and we're going to have crypto adoption for both retail and institutional investors. So I think there's good points to be made that the U.S. needs to worry about its own home market, but other people are not going to wait for the U.S. to make up its mind.
Okay. Glenn, anything to add, or do you want to pass and get the first crack at the last question?
I'll just tag on just quickly. I'm not. Glenn said everything really well with respect to global regulation. I think just the important underlying point is that we have a clear roadmap. Like, if we can have a clear roadmap, all of the different parties can come to the table and figure out how to do it, work together, and do something where no one's going to get sued, no regulators are going to come in, and investors and retail protections are in place to keep everybody safe. So, I think that's really the long and short of it.
Okay. So we have about 3 minutes left. Glenn Morgan, I'll give you the last chance at the first chance at the last question. So let's talk about predictions. So a year from now, we're back at this event, and we'll be talking about institutional adoption in a new way. There'll be new stories. So a year from now, what will be the institutional adoption of crypto story trend that you expect us to be kind of focused on in the coming months? Yeah.
Definitely could make some predictions. I think, maybe we see an ETF, maybe the Grayscale, they just had a good day in court with the SEC, and there's predictions of which way that might go, but I think we might see them successful with a spot ETF, and then others like BlackRock soon to follow. So I don't know. We'll pass it on.
Okay, Jim, would you like to take a shot at the?
I mean, my prediction is regulatory clarity. I'm hopeful that there can be some guidance and rules and regulations that just provides additional information for everybody to run with. There was a figure earlier today that 30% of banks' costs are related to compliance, and in my view, that's completely unsustainable. There needs to be ways to use technology and artificial intelligence in the compliance space to reduce staff and reduce these burdens, because that's a huge number.
Yeah, I agree. I mean, our company, we're in the reg tech space, and we see the need to invest more and do that side of the business more efficiently as a key driver of innovation. Any other predictions, John?
I do predict, listen, all of the potential success stories for a year from now are already in market. They're already in flight, right? We're probably watching them go by along with a whole bunch of other news, so it's easy to get distracted. But I do think, listen, success that I predict for the next 12 months will be examples where, and Jim's taken us, through a great list of, a lot of regulatory I's that need to be dotted and a lot of regulatory T's that need to be crossed. But the most successful use cases over the next 12 months are going to be the ones that demonstrate the ability to dot those I's, cross those T's, and get this tech deployed within the confines and the constraints of the regulatory and legal environment. That's where success is really, rests with for all of us. And it's also the obligation we have to keep pushing.
Last word, Glenn.
All right. I don't know if this is a prediction, it's more of a hope. I think the single biggest seminal event that we need at this point is for a true blockchain use case to be proven and utilized, right? I mean, you have an immutable global database. You can solve logistics problems. You can eliminate rent-seeking behavior. You can squeeze the fees out of real estate. You can put everyone subject to the right privacy and availability. You put medical records on a blockchain. Right? And so I think the single biggest driver, which I hope is a prediction at this point, is for the average person to see what blockchain technology can actually do for the global economy in terms of making it more efficient and more productive and more scalable. And once someone says, oh my goodness, I see blockchain technology solving traffic problems, for example, then all of a sudden becomes less about the regulation and the crypto sitting on top of it, but more about the use case of the technology itself, which I think is really, really important.
Thank you, panelists. Thanks to the audience, and we'll be happy to continue the conversation in the hallway after this event. Thank you.